Well, I feel very lucky to be hosting this panel today with all of these excellent guests. I also think we're probably chatting about one of the most interesting and hot topics going on in crypto and DeFi specifically at the moment. So really looking forward to welcoming everybody. Do you guys each just want to do a quick, 15-second intro, and then we'll hop into questions and stuff?
Yeah, sure. I'm Ermin from dHedge. dHedge provides on-chain vault infrastructure, so anyone can create their own vaults permissionlessly. So you can do anything from, create index vaults, yield, market-neutral strategies, but also more directional vaults for like leverage tokens, and we provide some other infrastructure as well on that. And we have a couple of brands, MStable for yield and Taurus Finance for leverage tokens. So yeah, we've been in the game since 2020, and thanks for having me on.
Of course. Mark.
Hey, Mark Phillips, co-founder of Steakhouse Financial and Grove Labs. Steakhouse is an on-chain asset manager and advisory firm. We're most known for curating stablecoin vaults, lending vaults on Morpho, as well as Camino and Solana. And on the Grove Labs side, we are building credit and liquidity infrastructure. So right now, that is mostly borrowing from Sky's balance sheet up to $2.5 billion and allocating that across various on and off-chain forms of credit.
Hi, I'm Mona, founded Enzyme and Avantgarde. Enzyme is a protocol for building tokenized financial instruments. And Avantgarde is a vault curator. We focused on yield strategies, applying traditional portfolio construction and risk management practices on-chain.
Hi, I'm Stuti. I'm a partner at Triton Capital. We are formerly known as Kraken Ventures. Our thesis is that blockchain is better technology infrastructure for financial services. So a lot of what you're building and researching and working on today is directly relevant to us. And speaking of Vault Summit, we're also investors in Morpho.
Nice. Great. So I guess I didn't introduce myself. I'm Ryan, co-founder of vaults.fyi. Single API, integrate dozens of different DeFi protocols, including ones from Steakhouse, for example, directly into your product. So maybe the simplest place to start on a curator panel is kind of with actually the definition of what a curator is. Because I guess when I feel like I was probably first introduced to that, as kind of Morpho curators, eventually Euler curators, and it feels like the role of a curator has changed a lot, kind of looking at recent events, the stream finance stuff, and some of the riskier things that curators are doing. So can anyone help for the audience today, just kind of defining maybe what a curator was originally envisioned to be and what that's kind of evolved into? I'll lob it up there.
Yeah, I guess I'll start. So to me, curation is all about risk underwriting and risk management, and it's always been about that to me. So I think each curator sees and takes a different approach to kind of how they manage their vaults. Some are, purely trying to maximize short-term yield. That hasn't worked out as evidenced over the last few weeks. And then others, like Steakhouse, are focused purely on risk-adjusted returns. So we're looking at assets and trying to find the best ones with the least chance of any sort of liquidity or credit event that would lead to our lenders, losing their capital. So we are hyper-focused on lenders, and we're also writing, algorithms to help effectively allocate liquidity across the various collateral markets on Morpho. So that's kind of how we think about things and kind of what we're trying to do at Steakhouse.
Yeah, I think, I totally agree. There's a lot of risk management. But I think, what we've seen in recent weeks is that there's really very different standards in risk management and how that due diligence approach is taken. So, I think over time we'll see, the players that are actually doing proper DD and having proper risk management, they'll probably stick around, and we'll see a lot of players drop out as well over the years.
Yeah, I think I would agree with everything said. I think I would maybe just layer in a point here that, some vault curators are explicitly high risk versus low risk. And so just because they held a position in a certain, in a certain protocol is not necessarily something that they should be judged negatively by, because at the end of the day, yield is only possible by taking some level of risk, and the higher yield and the higher risking strategies you take, there's always going to be some probability of defaults there. It's really more just about how you construct the portfolio and manage the risk. And that's not just about having positions that don't blow up, it's also about managing liquidity in difficult situations, making sure that all investors or depositors get treated equally. As we saw like last week or a couple of weeks ago, there were some very interesting runs on vaults where, people got out on preferential terms. There wasn't like infrastructure or even foresight to think about side pocketing, bad positions or gating vaults to the extent that that was possible. And so I think that the curator's role is more just about, managing which position, but also thinking about the bigger questions like liquidity and how to deal with situations such that all depositors are treated equally.
Yeah, I guess maybe a related question to kind of jump off some of this is just around like the competitive nature between different curators then and some of the differentiation. Because I think maybe hearing some of what you guys are saying, obviously risk management and not losing money is maybe the core of what curators should be doing. But it feels like because there's curators competing to attract capital, there's probably also a dynamic where, to that point, people are competing further out on the risk spectrum as well. So I'd be curious how you guys are thinking about some of the differentiation between these different curators, and if that's starting to become more pronounced to people who are depositing into these products.
Yeah, so I think risk curators, across the board, they have very similar jobs the way that, say, like a stablecoin issuer has a similar job. And at the end of the day, that means that differentiation kind of comes down to often the wrapper that you put around, your risk curation business, which is marketing and brand, and distribution. So, for example, when it comes to distribution, I think Gauntlet has done a really good job with kind of putting out like the academic papers and, Tarun being on the chopping block and such. And I think that starts to shape like, what is the vibe of working with Gauntlet? Steakhouse, for example, they have this partnership with Coinbase, like on, Morpho and the Morpho, like the DeFi mullet. And, I think that then positions them as, an interesting curator to work with when it comes to centralized exchanges. So while the underlying product is going to be similar, I think a lot of the differentiation, even on, what their risk models are, or, do they use something like, Aragon for governance and giving LPs, more say, more protection. In my opinion, it kind of comes down to these are marketing tools to differentiate them from each other.
Yeah, I would actually argue that a lot of the differentiation is in what you don't see, what's not so obvious. So what happens behind the scene in terms of risk management, in terms of the tools that go into monitoring, the tools that go into risk management, and also you touched on it as well, but like the different roles in terms of whether it's governance, whether it's like, in the case where some Oracle needs to be provided to publish a NAV on chain, who's publishing the NAV? Is there a conflict of interest? Looking deeper into conflicts of interest, which there's a lot of in DeFi and that are not always and actually frequently not disclosed. So I think those are the things which really differentiate things that you can't see that are not obvious.
Yeah, I'd say for Steakhouse and Grove, we're focused on, as I mentioned earlier, risk-adjusted return, but also on transparency. Like we want to be the most transparent curator because, every curator or risk manager can say they have, the most like fancy, intelligent risk models and that they drive superior, performance. But if you're not transparency about kind of how you're evaluating risk and underwriting risk, then I don't think that's someone that you should really trust with your money personally. So, any sort of novel asset that we underwrite, put on collateral on Morpho or on Camino, we're trying to be as transparent as possible and sharing kind of how we're looking at the risk of these assets. Like we're not going to look at assets and underwrite assets that we feel like have zero risk. They're all going to have some level of risk when you're lending outside of the prime vaults that just lend against Bitcoin and ETH and treasuries. But, there is a huge demand for incremental yield across the space. And if we're being transparent with the risks about, these various collateral assets we're adding, then people will go in, hopefully eyes wide open, understanding that, there is a chance that, there's some sort of credit event and these are the risks that I need to be aware of if I'm lending into this vault. So, the most recent example of this is we underwrote a asset manager's product called Fastenar's MF1 fund, and that's been the fastest growing private credit fund on chain, as it's been kind of constructed from like a pure private credit fund, which is typically closed ended in quarterly redemptions, into something that has like a 10%. We got a liquidity sleeve. So 10% of the fund is basically liquid, atomic, on chain, and you can lever up a lot easier and also unwind positions a lot easier because there's always intraday liquidity. So for us, it's all about how can we be the most transparent, how can we share the risks with our users visibly, and that's how we feel we'll build more trust with the market.
Yeah, I'm actually curious about this. The whole transparency thing, you can only go so far, but with the underlying assets, so say like, for example, the Fastenara MF1 fund, you kind of look at it and you go to the Midas app and it's a bit of a black box in terms of the funds are off chain. Okay, this is a reputable asset manager. But, you look at how does an average retail user know, like, what's my actual risk? So, you look at the attestations and it's done by the fund manager themselves. I haven't been able to sort of see like a published third-party audit on the assets. And you could say, okay, this is if you do more digging, okay, this is a more reputable asset manager. But in terms of transparency on the underlying asset, how do we expect an average retail user to differentiate between something like this and stream DeFi? So I think it just becomes very difficult. And that's just, the off-chain funds, not to take into account oracles and oracle risk and more technical issues. So I think it's like really difficult for retail users in particular to differentiate. Even as a curator, you can be as transparent as possible. The underlying assets often are not or can be very complex.
Yeah, that's why I think like if a curator is originating some sort of new and complex asset, they should post some sort of thorough risk assessment. And we published probably a 25-page memo on Fastenar and how the fund works and the underlying assets in the portfolio. So it may not be on Midas, but head over to Steakhouse.financial and you'll see a ton of information on this fund and this product.
Yeah, I mean, one thing I would love to see that would help me distinguish curators from each other, especially like on a vault level, is just, maybe more standardized risk dashboards as well as just performance. Like, I think the risk curation industry is super nascent right now, so you don't have very clear leaders and very clear track records. Like, you have like the semblance of one, but starting to formalize that and making it standard would, I think, help clarify a lot for people coming in and evaluating.
Yeah, I agree with that. I spoke about this earlier today, but I think the fact that the industry mostly holds itself, and I'm talking about depositors, to APY as a metric, rather than looking at things like total expense ratio, slippage, transaction fees, or just liquidity, or, it's been too long that we're only pinned on APY and it doesn't even tell you anything about future or past performance. It's just a snapshot in a point in time, which is, I wouldn't go as far to say is useless, but on its own, it's not a very useful metric. So I think we definitely need more transparency. And I'd love to see players like, Credora and all those guys to give more smart transparency in terms of ratings, not just you hold this position, so therefore you're a risky vault, but more thoughtful metrics that investors can use to make informed decisions.
Absolutely. Couldn't agree more that current APY is a pretty flawed metric. On our site specifically, we only show 1 day, 7 day, 30-day historical averages just to sort of give something that we think is more representative of what you'd actually earn. But going off of something that Stuti said, and then I think kind of going off some of Mark's points as well, in terms of the lenders or depositors into these products having sort of more assurance that they're in, something that they can trust. Mark's co-founder, Seb in the front row here, just tweeted the other day about first loss capital in some of these pools. And so I'm curious today if you guys have a sense of how many curators actually do deposit, their own money at all into these products. I'm not aware of anyone actually having like a proper enforced on-chain junior tranche on like any of these pools, but would love to see what you guys think of that, and if that's a space you think we'll see some more of these lender protections coming in.
Yeah, we have most of our treasury assets in the vaults. We want to always be maximally aligned with the lenders, and I think the only way to do that is to actually have some skin in the game. We've also, ideated a little bit on various mechanisms that would act as some form of junior capital, but it would probably be better served by a more, formal mechanism that would, facilitate, because there are, some users that just like want to deposit once and like then check back on their yield like a year later, and they're not going to like get out so that you're, taking the loss purely yourself under like the current time lock mechanism. And then when that bad debt is taken, like it was in a few other Curators vaults the past few weeks, it's split across, all the lenders. So for it to be a true junior capital position, it needs to take, 100% of the first loss coming into it. But also on the, the growth side, we're about to deploy, several $100 million into Morpho vaults that Steakhouse curates. So we have a very strong belief in the infrastructure and the risk underwriting that we're doing. So, we're putting our money where our mouths are with our products.
So personally, I would love to see also more transparency when it comes to looking at vaults in terms of, which curators are actually providing like personal first loss capital. It's quite common in, the venture capital model that, when we go out and pitch to LPs and, close a fund, that the general partner is putting in some personal capital into that LP pool as well to show that there is skin in the game. I think one difference though is a lot of GPs do take a line of credit that certain institutions are willing to provide them, and that model doesn't really exist necessarily in crypto. But I think it would give lenders a lot more peace if they could see across different vaults that curators have put in their own capital.
Yeah, I think it's great to see, Steakhouse putting into their own vaults. I think every curator should be doing this. We have a saying internally, which is we need to eat our own dog food. And if you're not eating your own dog food, then you should be asking a question why, and particularly for yield. And usually it means that the risk return is not good enough. And if that's not the case, then you probably shouldn't be offering it to anyone else.
Yeah, and just to also extend on this, I think there's a fundamental reason why this is important that I think we haven't really covered, which is incentive alignment. Like the way that the curator model works right now is curators, most of them make money off of their performance fees, right? So any vault that they set up, if it performs well, then they get to take a cut off of that. However, if it doesn't perform well, the downside is zero. It's not negative. So what that means is that curators can be incentivized in order to set up, high yielding vaults, because that might result in better performance fees, but also no loss of principal for them. So something like a kind of first loss tranche that is personal would be stronger incentive alignment.
Excellent. Well, we've talked a lot about risk. I'm also curious how, in some of the conversations that you guys are having, how people, or let's pick a specific group, how maybe more traditional institutions are thinking about sort of the risk-free rate plus X that they're expecting when they're lending into or depositing into crypto type products. I feel like today, I actually should have looked at this before, but if I were to kind of scan the largest Morpho pools, largest Morpho vaults, largest Aave pools, et cetera, for stablecoins today, maybe we're in the 4 or 5% range, something like that, without incentives, of course. Is that sufficient for people that you guys are talking to, or how are they thinking about the risks of depositing into crypto products today?
Yeah, I think it depends on kind of who the integration partner is and kind of what the goals are. For various liquid crypto hedge funds, they're looking for a place to park their cash and have it instantly available when there's an on-chain opportunity. So for example, I think a few months ago, Plasma did an ICO type of event. And the second piece of that ICO event was unannounced, and you had basically an hour to get in, I think. And we saw people, moving cash out of vaults into the ICO. And that's just a part of the ecosystem that wants to have their cash earning some yield, but have it instantly available, not T+1 like treasuries on chain, but instantly available so they can, ape into whatever new, ICO or token is. On the kind of more institutional integration side, I think they think about it a little differently. they're for sure trying to earn some spread above treasuries. Otherwise, why would you, put funds on chain, expose them to like collateral, credit risk, smart contract risk, et cetera. But the ecosystem is so like heavily based around these like repo type markets that sort of like product doesn't really exist yet. But I think that's going to change with Morpho V2 when you can directly allocate to assets. So, there could be basically a vault where you deploy directly in treasuries if the prime lending rate for like Bitcoin and ETH is below like the T-bill yield. So I think right now, like we're in an era where the infrastructure just hasn't matured enough for these like market inefficiencies to no longer exist. And then once it has, I think you're going to start seeing like spreads above, SOFR and T-bills.
Yeah, I think 4 or 5% is not enough. So we aim for double-digit yields, but we're very conservative on the assets and the protocols that we use. The differentiator for us is more the automation, more like transaction-heavy, very heavy operations, and just automating that liquidation protections beyond what you can do as a regular user or without automation.
Yeah. So, what I see is like more sophisticated actors, they do expect yield that's above the risk-free rate because they are taking, in addition, they're taking smart contract risk, operational risk, they're taking regulatory risk. But then on the other hand, if you have instant redemption, which you don't have if you're investing in, say, a hedge fund or a hedge fund type entity, you can then also take a discount on that. So that's more for like the sophisticated or institutional actor. I think when it comes to kind of DeFi retail, things get a lot more confusing, or it's a little less rational because everybody just expects yield not everyone, many actors expect yield with some risk-free assumptions in their mind.
Great. Well, Mark, you make the point about instant liquidity, and I do think that like fundamentally that's such a key piece of how people think about yield in crypto today, that you can deposit, withdraw at any time. Obviously, there's a lot of newer protocols, Vita, Midas, Upshift, using, I always forget the standard, but the asynchronous ERC 7540, something like that, where they have maybe a 3-day withdrawal window. So you basically enter a cooldown period and then you withdraw. I think probably for the managers, this gives a lot more flexibility, comfort, maybe to do more duration strategies, also breaks some composability of these things as well. I'm curious how anyone on stage really has thought about the sort of trade-offs of having more asynchronous and actually trading off some of that instant liquidity, and if that's things you're building towards or maybe what that unlocks.
Yeah, it's definitely something that we're building towards, and I think it's just the natural evolution of the market. Like the crypto market is so like retail driven, but like the institutional credit markets are all based around duration. So like they look at crypto and they're like instant atomic liquidity, like 24/7, like what is this? But like every like almost every credit product, it has some sort of like meaningful duration in traditional finance. So I think it's just inevitable that as better products and infrastructure evolve, you're going to see more duration types of products.
Yeah, and I think that there are tools actually being built that will help solve this problem. Like Cork Protocol, for example, has been working on a solution where a third party can take on the duration risk immediately, which then goes back to the point of things being more immediate and composable. And that could really be a big problem solver for the industry, for example.
Great. Yeah, and I guess jumping around a little bit, thinking about the curator model perhaps a bit more generally, is it safe to say at this point that this model of, whether kind of obviously what Morpho's done, what Euler's done, but also now what Aave's doing with V4, what Spark is doing, and I suppose Grove is doing as well with this sort of allocator type model, is this just kind of the de facto standard? And is the previous way we've thought about lending markets being more of these single pool type of structures, is that a thing of the past and this model is sort of the guaranteed winner, or do you think that there's still a place for more of the Aave V3 type models out there in lending?
I feel like Aave until now has kind of been stuck in this middle ground, like the single pool, and then all the risk is shared between the different collateral. And and they have to be very conservative on the collateral that they provide. So I think what Aave is doing with V4 is maybe a little bit different, where they want to expand to these different markets where you can kind of choose, do you want to be more conservative, or do you want to just focus on RWAs, or do you want to go up the risk curve? But I think that maybe some of the takes have been that they're moving more towards a curator model, but I don't think they are. I think they'll still be the ultimate curator. So I think what they're doing is maybe something a little bit different. But it'll be interesting to see the growth of Aave V4, and probably would expect like a flippening of TVL within the next 6 to 12 months.
Bold claim.
Yeah, I think the evolution from the monolithic design to these more modular designs is just going to keep pace, because I think sophisticated lenders want to know what collateral they're exposed to, and also want to dictate kind of what their lending strategy is. So if you're lending into a monolithic protocol, you're basically giving up all that discretion and strategy to the one kind of risk manager that works for that monolithic protocol. But in the curation model, you can really kind of have way more options in terms of kind of how much risk you're taking and what assets you lend against. And that is in terms of the assets that you are lending against as a curator, that's one thing I think needs to be improved more broadly, is just more transparency on what all these assets are. If you go on a protocol like Pandey, I'm seeing brand new projects every day. I have no idea what they are. I work in this industry full time. So if someone that's super crypto DeFi native is looking on Pandey and seeing a ton of assets and they don't know what they are, that's not a great thing in my view. But the nice thing about Pandey is they have all these information bubbles where you can click on the asset, and it's this asset is cap.finance, tokenized, whatever. And you can go to their website and read more about that from there. That sort of information capability does not exist on a lot of other lending protocols today. So you're just looking across PT dash SX dash November 30th. And you're okay, I don't know what this is, but I guess I trust Steakhouse, so I'll give them my money. And that I think just needs to be better.
Yeah, I believe that the modular model, such as Morpho right now, this is the future. I think being able to create these isolated markets where you can have a lot more transparency and also kind of agency over the kind of risk that you want to take, and the kind of assets that you want to be exposed to, and the type of curators that you want to work with, is very important as liquidity expands in crypto. I think when liquidity was more constrained and it was kind of the same 100 people over and over again in every DeFi protocol, the old model still made sense. But now when you also have new kinds of players coming in, kind of not just this DeFi native, DeFi degen crowd, institutions, for example, they want to be able to isolate the risk that they're exposed to. Maybe they want KYC hooks in the pools that they are participating in. And yeah, I think that the new modular style is really the style that we need for the future of crypto.
Well, Mark, you gave me another good jumping off point there, which was, you said, someone looks at Pandey and they say, I'll just put my money with Steakhouse. I trust them. And something I've been wondering about is, when someone does look at one of these, one of your products, for example, how much of their evaluation criteria, if they're evaluating anything at all, is I trust Steakhouse versus I trust Morpho? So it's okay, I see all of these names on Morpho. This one's not, maybe I don't want to put my money in the highest. That seems too sketchy. I'll pick the second or third highest. And that just happens to be Steakhouse sometimes. Perhaps a spicier way maybe I can ask this question is if you guys stopped curating on Morpho and moved to Euler, do you think you'd still have the same kind of success and TVL growth? Or I guess what I'm trying to ask is, what's the split when someone's evaluating between the curator and the underlying infrastructure?
Yeah, I think for retail, they're very focused on just the protocol first. And then they're looking at the top vaults and okay, this one looks like it has good yield. It's exposed to 10, 15 assets or whatever. I've maybe heard of this brand, this company, but I'm not super familiar with what they're doing. But they have a lot of money in their products, so I'm going to trust them. That's probably the thought process of a lot of less sophisticated retail participants. But it's a little different on the institutional side. Just due to the work that we were doing on Grove Labs, we're allocating a lot of capital in partnership with a lot of large asset managers. A lot of the big asset managers on Wall Street already know who we are. So if they're looking to participate and come on chain in a meaningful way, they're going to ask us how, or what's the difference between Morpho, Euler, Camino, Aave, Compound, et cetera. and they're kind of more looking for, advisory help on that perspective as well. But I think like every lending protocol is being pretty aggressive in terms of like sorting out and trying to find institutional partners and like key like distribution channels. But the curators are a big piece of that for institutions, and institutions want someone they can trust. They want legal people with legal entities, people with track records, people that have been in the space a long time. So I think it's really tough if you're like a brand new curator and you're trying to play catch up on like a new protocol that you may have not been one of the first several curators to kind of bet on, like we did.
So I think the type of risk that and the trust that LPs or retail or whatever the liquidity providers need to provide or entrust a protocol or a curator with is different. When it comes to like more for Euler, like the underlying protocol, the infrastructure for the lending borrowing, they should be looking at smart contract risk and technology risk. And then when it comes to actual the investment risk, that is on the curator. And I think that it is not necessarily seen that way all the time right now. And that's a bit of, it's a blessing and a curse that actually these protocols have just built better brands and better distribution than the curators themselves. I think the ideal is that the curators also build better brand and better distribution. So it's actually the trust around like the actual investment decision that's happening is with them and being extended to them.
Curators don't have tokens though, so that's a challenge because everyone likes tokens. Well, until the past couple of weeks at least.
Yeah, I was just going to touch on this earlier point that Mark made. You go to Pendle and you're like, what are these assets? It's like, it's just a sea of assets and it's hard to sort of determine, what's the risk. I was thinking like, what's a good proxy to kind of determine what the risk is? And I was thinking one thing you could do is check out some on-chain insurance protocol like, say, Nexus Mutual. See if they provide DPEG cover for that asset. And if they do, you can see kind of, how did they assess the risk and what that costs. And if they don't, then maybe ask the question, why haven't they provided cover for it?
Yeah, so one analogy I'd like to provide, I shared it on Twitter like, a week or two ago is, one should think of the lending borrowing protocol, so Morpho, for example, as the tools in a kitchen. So, it's the stovetop, it's the oven, it's the knives, it's the pots and pans. And then the risk curator is the chef, and it's also the restaurant brand. And so when people come to the restaurant, if they have a complaint or they want to leave a review, it should be about, the chef in the restaurant, not about, the tools that they necessarily use. And that's usually how it works. But as I said, I think that the shift towards this kind of framework on the level of like liquidity providers, it has to also be kind of orchestrated by a combination of the protocols and the curators as well.
Yeah, I think I totally agree with that. And I think I just want to reemphasize that I think, talking about like vaults that have a lot of TVL as a way that people build trust it's not, using the tools is not just about not having a blow up and not having or having a decent track record. I think it's also about curator thinking about things like liquidity, transparency, really kind of providing granular details. Like I think it's really, if I have to criticize DeFi, I think one really disappointing thing is that we still hold ourselves to APY as the only metric that we judge vault curators by pretty much. And I don't know why, because vault curation has been around for a really long time. And I think that we need to start getting smarter and looking at other metrics, liquidity, how well do they handle getting out of certain positions in tricky markets, how does liquidity change over time or in different market environments, and how I'm going to emphasize this again, but like, how do they treat their investors relative to one another? And maybe one other one I'll throw in there is conflicts of interest. I think there needs to be better disclosures around conflicts of interest because that creates weird dynamics that investors should be aware of.
I'd love to just double click on that. Conflicts of interest, I guess maybe in terms of the curators and say the assets that they're accepting as collateral, or what are some of the bigger conflicts that you've seen?
Yeah, I mean, it can exist anywhere. Like it can exist throughout the whole, what they're accepting as collateral. Are you accepting something as collateral because it's an asset that you really want to accept as collateral, or is it because that protocol is then depositing to your Morpho vault? Another angle maybe is so many vault curators publish their own NAVs on chain. Is that like ideal? No, it's not.
No, it's not.
So, I could go on for, what are the backdoor incentives? What are, these are things that are not visible to users. And there are things that influence, just going and trusting someone because their TVL is the biggest is pretty stupid, to be honest. Like asking more intelligent questions around and providing more intelligent metrics, I think is a much better way to move forward and also bring the industry forward and attract the next wave of smarter capital in.
Well, yeah, I mean, just going even a little bit more on that, I mean, thinking about the kind of stack of things that curators use today, what is it that's missing in the day-to-day of that job? And Mona, I know you guys are maybe building some things around kind of like different policy engines and tools as well, if you want to chat about that or open up to anybody as well.
Yeah, I mean, I can speak a little bit about how we curate these are not Morpho vaults, but our sort of enzyme vaults, for example. We build in permissions and policies that are on chain, that are very transparent, that show, that limit what a curator can and can't do. These are typically reviewed. We are, generally speaking, our vaults are not, some of them are, but with these enzyme vaults in particular, they're not open to the public. But they are, reviewed by our clients and they're accepted as a means in terms of the governance around them. We never are the owner of our own vaults, like, unanimously. Like we typically have multiple signers and more objectivity. And so you can really, governance really matters, and there are different roles, and it's important who takes on those roles and how they take on those roles. And those disclosures, I think, are important to the end depositors, and asking the right questions is really important.
Excellent. Well, as we're coming up on time here, I'd love to just sort of wrap on whether it's in this space of curation, DeFi, probably something in crypto and DeFi at least. What are you guys kind of most excited about in the next few months? Either things that you're working on or things that you're tracking industry-wise that people should keep an eye out for?
Yeah, I think this is kind of an early stage of vaults and people are very much looking at yield. But I think more structured products, different types of market exposures. I really think on-chain options are a really underexplored area as well. So I'd like to see DeFi kind of evolve and kind of innovate on some more traditional finance type products.
Yeah, I'm probably most excited about new sorts of assets being tokenized and originated on chain. So, historically we've had kind of a lot of crypto native assets. We've had some tokenized funds and whatnot, treasuries, et cetera. But now we're seeing some new types of RWAs, like USD AI is one, Daylight's another. And there's a whole slew of other kind of products that are going to be coming to market over the next 3 to 6 months. And I think that's going to, kind of broaden the kind of landscape that curators can work with.
Yeah, I think I'm interested also in options. I agree with Ermin there. I think that's an under sort of exploited area in DeFi. But I'm also excited about building smarter products around RWAs that have more transparency and hedge out the duration risk more cleverly.
I actually love to continue to see new stablecoins launch. I think we're definitely in a multi-stablecoin world, with each $1 actually just representing a simple UX to access other financial products. So that continues to be an area of interest. And then the other thing is just innovation on yield. I think there's many new kinds of yield sources, such as private credit coming online again. And there's various innovations in tranching, distribution, packaging that can be enabled. And then finally improving composability across RWAs and new types of assets that are coming on chain, because that's really the beauty of doing all of this in DeFi.
All right. Well, thank you everyone for sticking around. I'm very glad how much the crowd has filled up in the time that we've been sitting here. So hope we were able to deliver some good insights. And yeah, find us afterwards if you want to talk to anybody.